Hello, everyone, and welcome to Thoughtful Investing. Today, we're going to break down IDEXX Labs. It's one of my favorite companies in the pet care sector and a stock that I've followed for quite a few years. So I'm excited to bring this breakdown to you. So with that, let's get started. What does IDEXX really do? They provide diagnostic products and services for animal health. We're going to discuss that in a minute. They offer the practice management software that any vet's office is going to use. And they also provide some water and dairy testing solutions. Broadly speaking, the business is divided into three key segments. The bread and butter is the companion animal group. And that's where you have all the diagnostics, the lab services, and softwares for vets. So just to give you a taste of it, when you go to a vet's office, you're going to see these IDEXX machines. And so the vet is going to take a sample from your pet and put that in there and then determine if they're infected or not. And then there will be some samples, blood samples, for example, will be collected and they will be sent offsite to a lab. And that lab may also be owned by IDEXX. So that's the reference lab segment. And then the software really is the operating system of the vet's office. All the appointments are scheduled, the billing, the insurance, all the visits, all the test results come into it. All of that is combined in the software segment. And that's really what brings everything together from the point of care to the reference lab. They also have a small water quality segment, which is only 8% of revenue, where they provide microbe testing in recreational and drinking water. And then finally, they have a livestock, poultry, and dairy segment as well, where they have some diagnostic services for cattle and swine and poultry, and also pathogen detection and food production. Now let's take a look at the industry. If you look at the entire vet diagnostics industry, it's about $14.5 billion and is expected to grow at 8.5% from now till 2030. Of this market, IDEXX is about 17.5%, followed by Zoetis and a few others. But in point of care diagnostics, which is where IDEXX makes a lot of their money, they are clearly the market leader and no one even comes close. If I was to compare IDEXX with its competitors, the two big ones are Zoetis and Mars. With Zoetis, the focus is on vaccines and pharmaceuticals. They're like the Pfizer of the pet care industry, which is funny because they were spun out of Pfizer back in 2013. And then with Mars, they own about 2,000 pet hospitals and they have a huge lab network, but they don't come anywhere close to IDEXX in their point of care service offering. And so both of these competitors are big in their own right, but don't quite pose the same challenge to IDEXX. Let's have a look at the competitive advantage that IDEXX enjoys. I think the number one is really the integrated platform because they bring everything into it. Think about it from the time of scheduling an appointment with a vet all the way till testing and getting the results back. They are embedded in every part of that chain. And then they have a global presence, right? So it's not just in the US, although that is their largest market, but they are in every country that you can name. And then they have a constant innovation pipeline that keeps producing and producing. Right now, they're doing innovations in the cancer detection space. This company spends 6% of their revenue on R&D, which at this scale is quite a lot of money. And with that, what you get is a steady stream of innovations, of patents that expire all the way till 2040. And that makes the competitive moat deeper and deeper. Finally, the recurring revenue model and the financial strength. 70% of the revenue is recurring, right? Because think of the practice management software. As long as a vet is practicing their craft, they're going to have to pay those software service fees. Similarly, as long as you're testing specimens, you're going to need IDEXX's services from a reference lab perspective and also a point of care diagnostics perspective. And so the revenue just keeps coming and it's not as cyclical as one would assume. And then the financial strength, which we'll talk about in a later section, is also a key strength because they run a conservative balance sheet, which means they're not dependent on others during weak macroeconomic environments, which is where we might be headed in the near future. I believe that this business has a long growth runway ahead of it, and really it's a combination of several factors. This is a slide straight out of their investor day, but I think it does a great job of explaining where the future growth is going to come from. The biggest part of it is really a growing pet population with longer lifespans. So back in the 90s, 60% of US households had pets, and now it's up to 70%. And in terms of lifespans, the average cat is living 1.9 years more than it used to, and the average dog is living 1.4 years. So as that end portion of your life is extended, there's going to be a consequent increase in the utilization of pet medical services. And then, as I mentioned again, a relentless innovation. Every year they come up with more point of care innovations as well as innovations in testing at later stages of the medical care. and deep customer focus, engagement, and education. And really the integration of everything from diagnostics data from all the test results to data and software combined, and then productivity enhancement that any practice management software is going to do makes it a compelling proposition for vet practices. I think because of these tailwinds, I believe IDEXX is set to grow in the coming years. Now, no business is without risks, so I want to make sure that I address those as well. The number one risk really is economic sensitivity. We saw that in the first quarter 2025 earnings call, where there was a decline in the vet visits, and that really set investors panicking, although it was not really that big of a deal. But when you enter a weak macroeconomic environment, you're going to have slightly fewer pet visits, but it's not as if they're going to fall through a cliff. I went as far back as the financial crisis, and there was not a big change in revenue year on year, even during that time. Because if your pet is sick, ultimately you're going to have to take them to the vet. The other couple of risks are really run-of-the-mill. Competitive pressures are always there. This is a business that enjoys considerable margins, as we'll see later. And so there are always competitors who are vying for that market share, people like Zoetis and others. But so far, no one has come close. And part of that really is how much money they spend on innovation and staying ahead of the curve. There is some regulatory risk because they're regulated by different regulators, everybody from FDA to Department of Agriculture. But because of their mission to enhance pet health, I doubt that they're going to be in thick waters with the regulators, especially because there's no past history of any problems. Technology disruption is another risk that can come into play. But for someone to truly displace IDEXX, they have to match the entire value proposition from software to services to diagnostics. And we haven't really seen anyone come close to IDEXX in all of those areas. And then you're left with currency exposure because IDEXX does businesses in more than 100 countries around the world. But this could be a mixed blessing if you enter an environment where the US dollar is weakened, then that international revenue is actually going to be worth more in US dollars. So it could go either way. All right, so with that, let's move on to the financial segment of the breakdown. We're going to start with the revenue and growth. As you can see, back in 2015, the revenue was about $1.6 billion, but by the time we got to 2024, it's almost $4 billion, 10% revenue CAGR, but net income grew faster than that, so 12.7% over the past 10 years. And then EPS grew even faster, and that's really a result of the buybacks that they did, which is why the earnings per share grew more than the net income. And with every time you have the net income growing faster than revenue, what it tells you is that the business has operating leverage, which means that every additional dollar of revenue is more profitable than the last one. As you can see, a pretty pristine record on EPS growth. There was some COVID pull forward back in 2021, and then it came down a bit, but then it resumed its positive trajectory from that point on. The revenue growth rate has been positive every single year, and so that's always a good sign because the business is constantly expanding. Now, moving on to profitability, we're going to start with the margins. And so the gross margin is pretty good, about 60 percentage points. So that's really good. What that means is that if they earn $100, only 40 of them, give or take, go to the cost of production, and everything else is in gross profit. And that's really helpful because in a high inflationary environment, what you're going to see is that the cost of different products is going to go up really high. And so if you have a big gross margin, you have a lot more capacity to absorb inflation than another business that has a much lower gross margin. And the operating margin, about 30%, is also pretty good. Net margin, again, 22.8%, very healthy. In fact, they've actually increased their margins over time. So it used to be 18.7% 10 years ago, and now it's all the way up to 22.8%. So constantly, they're getting into high value revenue streams. If you look at the shareholder returns, the 10-year stock return has been 5.5 times. So if you put your money in the stock 10 years ago, you would be sitting at a nice 558% return, which is not bad at all. If you look at the overall shareholder returns, they've been positive, except 1 year. This is 2022, remember, when we had the recession scare. And that's when the market went down quite a bit, and IDEXX dipped with it. But since then, it has recovered and is still in positive trajectory for both 2023 and 2024. And if you move on to the buybacks, they are pretty much a buyback machine. They bought quite a bunch of stocks during COVID. and afterwards. And then even most recently, they spent about $837 billion on buybacks. And so what that really does, as I mentioned earlier, is accelerate your earning per share growth, which is really what you as a shareholder care about. Now, if I move on to liquidity ratios, current ratio, quick ratio, and cash, what they all basically measure is how easy is it for you to settle your current liabilities. If you look at the cash ratio, they can settle about a third of their current liabilities just with the cash that's sitting on the balance sheet. Quick ratio, again, all of their current assets minus inventory. That's enough to basically settle their current liabilities. So a very healthy ratio. They have declined a bit over time, but they're still in a very healthy range. So nothing really to be concerned about. So moving on to the capital structure, if you look at the debt to equity trend, it was always pretty good. They started off at 0.26 back in 2015, and right now they're at 0.54. I think it's still pretty healthy. There was a jump in 2022, and that's because they raised a lot of long-term debt to finance some of their longer-term strategic initiatives. And given the returns that these guys get on the capital that they employ, I am more than willing to give them the liberty to raise more capital and then ensure even more profit down the lane. Now, moving on to the competition and how they are valued relative to their competitors, you can see that in terms of PE ratio, they pretty much lead everyone else. PE ratio is really a way for the market to judge how fast earnings are going to grow for a given business. So a high PE ratio basically means that the market expects this company to grow quite a bit. It's higher than Zoetis and Thermo Fisher, which really is not a direct competitor in a lot of different ways. But they do have some offerings which intersect with IDEXX. And then the BIM is a French company, and they have some small diagnostic services, but again, not really a match for the full service offering that IDEXX provides. Again, EV to EBITDA multiples that IDEXX trades at a premium valuation, and the performance of the business more than justifies it. In terms of the operating margins, IDEXX pretty much leads the pack, with the exception of Zoetis, which has an even higher operating margin, but it's not as attractive because of the lack of a software offering, which is something that investors love. Looking at the return on equity and assets, IDEXX again is in the lead. So overall, you can see that this business trades at a premium valuation, which is justified by their performance so far. Which brings us to the final piece of the puzzle, which is valuation. Now, I personally am a stickler for valuation because you can buy a great business at an elevated price and then as a result suffer a loss. And so a great business isn't necessarily a great stock. You have to make sure that you buy it at a reasonable price point. Now, assuming an 8% cost of capital and a 7.5% free cash flow growth over the next 5 years, and then applying a terminal growth afterwards, the value comes to about $485. I personally think that this is an attractive business below $420. And this is a price point that the business has actually recently traded at. If you look at their price back in April, and when they released their first quarter earnings, and showed that there was a decline in vet visits because of the weak macroeconomic environment. And then that was coupled by the tariff war that happened, which also resulted in the market getting tanked. IDEXX share price declined as well, and it came below 400 even. And so 420 or below, I think, is a reasonable target. If it gets there, I think it would be an attractive stock for the long term based on the sound business fundamentals, the history of share price appreciation, and really a strong balance sheet, great competitive position, and great industry tailwinds that can really generate good returns over the next few years. So with that, we're going to call it a wrap. I hope you all enjoyed the breakdown today. If there's any other company that I can break down for you, please let me know. Thank you so much for watching, and I look forward to speaking to you guys again soon.